So with the backdrop of what was a very challenging 2022, I think the results actually were very solid and much stronger than I anticipated, probably at the beginning of the year. And within that, I should point out as well that we delivered an adjusted cost-income ratio of 60.6%, around 60% for the full year. We kept that guidance during the year, so we were able to manage the cost base, the efficiencies, to deliver a pretty strong result overall.
And how did it come that, despite like flat revenues, the net income actually declined?
So we had a number of exceptional items that took place last year, one of which was an impairment on an intangible asset that we carry. We had a 68 million intangible asset impairment, so an unusual exceptional item that we took in Q4. We took some severance and restructuring costs. We are looking forward, and we know that we need to do some restructuring in order to achieve our forward guidance around a future cost-income ratio. So we started that restructuring programme in Q4, and there is more to come on that. And we have our platform transformation, where we are looking to shift to the cloud infrastructure environment and really overhaul our technology capabilities. Those are exceptional expenses that do hit the bottom line, but as we move forward into the medium term, of course, we want to mitigate those as far as possible.
Let's look ahead into 2023, because clearly the markets have been quite volatile last year. So what are you expecting for this year? Will there be like a big shift into fixed income again?
Well, I think we are constructive coming into 2023. You know, 22 was difficult on all fronts, but let's hope we have hit the peak of inflation. We're seeing rates hopefully again start to stabilise. I know we've still got rate rises, but I think as we come into 2023, we are constructive on the outlook, and I think that means that we can start to see some returns coming from the fixed income portfolio. I think where clients have been very risk off and risk averse at the beginning of 2022, we're starting to see some movement in risk appetite. So fixed income, absolutely, there should be opportunities in fixed income. We saw outflows in the fixed income asset class in 2022. We need to see that turn around, and I think we are well positioned for that. So moving into high yield, for example, corporate high yield, we've seen some signals of that in the fourth quarter. But also I think what's very important is that we can offer all asset classes across active, alternatives and passive ETF X-trackers. So being able to offer the full range to clients in this shifting market environment in the outlook will be very important. But absolutely, we need to deliver inflows in 2023.
You're saying that you have very high management fees, and that is one of the reasons why your revenues are flat year on year. Can you keep them up at that level?
Well, one of the drivers that we've seen last year is our alternatives platform. So real estate, liquid real assets and infrastructure, that asset class has performed very well. We've seen inflows last year, and we've seen more than a 20% increase in management fees in 2022. So, of course, this is an important part of our growth strategy, and it's important to address that question, can we maintain growth in management fees? So we're very much investing into our alternatives platform. We see that as supporting that outlook. We're also seeing a turnaround in X-trackers. We're seeing inflows starting to come back in Q4 and into the start of this year. That should also help the outlook. But absolutely, it's challenging. We're only in January, February, so I'll remain slightly cautious, but with a positive outlook.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.